In this lecture we are going to study a simpler example of manipulation that occurred in the dollar versus the Japanese yen 15-minute chart. It's a simpler example because everything in this scenario occurs by the book, meaning that nothing too unexpected could throw us off and makes us miss the great opportunity that presented itself after the manipulation. Without further ado, let's jump right into the analysis itself. As you can see, I don't have a lot of information in the chart. Sometimes all you need to produce a high-quality analysis is a few major market vectors. You don't need to be looking too far back in price because the market does not have that much of a memory, and you will not be able to keep track of the immense amount of details anyway. As far as I'm concerned, this is a paradigm where everyone benefits, which is not usual because traders usually have to deal with uncomfortable realities. From number 1 to number 3, we can clearly see that the market created a lower low and a lower high. This is undeniable. For those of you who are desperately seeking for objective truths about price, this is one of them right here. Number 3 is lower than number 1, and this means that sellers from number 2 seem to be stronger than the buyers. When price breaks low number 1 to the downside, number 2 becomes a solid market structure. The difference between fractal flow students and the traders that are still trapped in shallow mentalities about the market is that we understand the subtle games that can be played on the chart, and we do not act by impulse. We investigate to reach the truth of the market. Any high or low is always a potential manipulation axis, so we have to carefully observe how price gets in these levels, and how it behaves when it gets there. Once again, we have to put ourselves in the shoes of retail traders. When price starts to rise after low 3, retail traders are immediately attracted to the high number 2. They see it as a good place to put a buy order. There is an interesting phenomenon going on here. The way human perception works is quite complicated, and we tend to think that we see a piece of information and then we infer its utility. That's not the case at all. We first see the utility, and then we infer the information itself. In other words, when retail traders look at the high number 2, they first see it as a place to go long because that's the way they think all the time. They are not actually seeing the high number 2 for what it is. They see what they want to see before they see things for what they really are. That's a major problem in the financial markets. Luckily for you and me, we are aware this sort of thing happens, so we can anticipate it. When price approaches high number 2, it starts to increase its volatility. This is the von Restorff effect happening in this example. When this happens, retail traders are sure they are correct about their long orders in high number 2. This creates a cluster of orders in the high number 2. Large traders are obviously well aware of that, so they will attempt to poke that cluster of orders to create a deep liquidity pool. You could wonder why large traders do that. They don't do that out of pure evil or malevolence. They have to create deep liquidity pools in order to get in the market with large positions at the same time that they don't distort price too much. That's basically a way to sneak in large trades in the market. It turns out that they must do this at the expense of the retail traders. That's exactly what happens in number 4. Observe that candle 4 pokes the high number 2 and closes below that level. Observe also the size of the upper tail of candle 4. The cluster of orders was triggered, then a deep liquidity pool was created, and the market depth increased significantly. This was the opportunity for large traders to assume the opposite position of retail traders, which in this case is a massive short position. This is basically large traders pushing retail traders off the cliff. Right after candle 4, retail traders are desperate or stopped out, so the reverse psychology begins. They suddenly realize that they did not consider the possibility that they could be incorrect about their upward market bias. This is reverse psychology because retail traders are led to one direction with the sole objective of being led to the opposite direction right after. The bandwagon effect is what follows the reverse psychology because retail traders become eager to recuperate their losses. What matters the most for us here in this course is that while all of this is happening, price will float around these important levels and it will give us opportunities to take a ride along the large traders. As you can see, I drew a black wash line and a red sloped wash line in the chart. Observe how nicely the red sloped wash line catches the frequency of the upper tails of the candles around number 4. Regardless of the line you choose to use as an entry method or the type of trigger that you decide to use in your trade, the stop loss is in the same area, and it should protect you in any case. The level of our stop loss would be above the high number 4, which was indeed the manipulation itself. The trade you see in the chart was opened when price touched the red sloped wash line for the 5th time. The target was place at the low number 3 to give me a 1-to-3 risk-reward ratio. Let's see how the trade turns out. As you can see here, the market hit our target successfully, rendering our analysis as correct.